Ladies and gentlemen, in the last 1 week alone, KEPPEL DC REIT has collapsed. The share price has plunged 13% in just 1 week. What happened? Was it something that you and I were able to preempt? Let's look at this in detail in this week's video. Ladies and gentlemen, yesterday Capital DC saw a tremendous increase in its volume. 32 million. It's been a long time since Capital DC has actually hit a volume of 32 million. Commensurately, the share price went south all the way down, as you can see from the share price chart. It's actually down 11 cents one particular day, but in the last 1 week alone, it's down 27 cents from 209 last Wednesday, right down to 182 yesterday. This is a fall of 13%. Now, in the history of Capital DC since it was listed, it's a very rare occasion. The last time when you saw the share price collapse that much in a short period of time was during the COVID-19 pandemic. So what happened? You look at the volume. Yesterday was 32 million. Just last Wednesday, a week ago, the volume was how much? Yes, 1.5 million. So what gives? Very clearly, the major institutions that are holding Capital DC as substantial shareholders have they given up on the stock, solid in the market, irrespective of the share price, or is there more to it? Let me share with you, ladies and gentlemen, what we have been actually saying in our past videos as well as actually our press media interview. Now, in May of this year, we have mentioned that Capital DC, in the lights of with United Hampshire, would probably be the ones that are fairly resilient. Granted that the acquisitions will not be too aggressive, and at that time, Capital DC was in the midst of completing their acquisitions on Guangdong 2 and Guangdong 3 data centers that they have actually acquired as part of a blanket measure to acquire and have foothold into Chinese data centers. Now, in our GCP Global investment classes, we have shared that this initiative is good because the foothold means that the NPI yield of the Chinese assets are close to 8%. But have they come at the wrong time? Because this means that Capital DC have to gear up at the time where interest rates are on the increase. And in our 联合早报 interview on Monday, 15 May 2023, as you can see, we have mentioned other REITs that already been caught in a rut of the credit crunch. So the likes of, for example, Fraser Logistics Trust, Manulife, Capital Oat, ARA, Hospitality Trust, EC World REIT, Daxing REIT. These are the ones to really stay away. That was actually in the early part of this year. But we did already had so the roots of the problems in Capital DC. And in our last interview, which is the Business Times just last month, we have mentioned that in interest rates environment, it's always good to stay away from real estate investment trusts because as well as actually other instruments that are affected of higher interest rates. Because what happened is that this current period of rate hikes, may I just quote what I've said in the Business Times? It are similar to the 1970s, which actually brought many US REITs and European REITs listed at that time to their knees. Gabriel Yap said that loss of confidence can quickly give way to liquidity risk, which in turn can lead to insolvency risk. Now, ladies and gentlemen, not many of you all have actually lived through the difficult times of the 70s. Now, I would happen to be one of them. And let me tell you that when interest rates went up to 16% at that time, all hell broke loose. And it really doesn't need too much hell to break loose on share prices, confidence, liquidity. People go into bad mood. But hang on, take a step back. The whole idea of investing in real estate investment trust is to get steady, consistent income, right? So the moment this consistent income is being threatened, you as investor should be taking initial steps to actually sidetrack this or even to avoid these investments, which is exactly what we have been teaching at GCP Global classes since last year when interest rates actually went up. And this is actually very applicable to Capital DC. How is that so? Let's look at Capital DC latest set of results. Now, this latest set of results, Capital DC would like to have you believe that they have delivered a resilient financial performance. Well, how true is that, ladies and gentlemen? You look at the results in detail. The finance costs actually surged a huge 67% from 21.2 million to 35.5 million in the first 9 months of this year. Now, this therefore wreaked havoc in the distributable income and the DPU, which actually went down by 2.1% and 1.2%. Now, ladies and gentlemen, therefore, how is this resilient? Food for thought, right? Okay, so if anything, ladies and gentlemen, at GCP Global, we don't actually buy into the traditional media hype. And when earlier on, as you can see from the share price chart, when the share price of Capital DC did rebound, we told our participants as well as investors in our GCP Global investment classes to take profit and avoid and take that opportunity, that bounce in the share price to actually exceed. That's because in the previous narrative. Data centers, as mentioned, and called from meeting with uh, fund managers and investment analysts, were in the spotlight because of the rise in AI, artificial intelligence. So that report was speculating that essentially that investors were looking to position into data center REITs. We told our investors that, wow, this is fine, but when the share price bounced like that, it's time to take profit and avoid this route as what it is. And you may ask, ladies and gentlemen, whether there's therefore a silver lining in Capital DC. Now, one of the slides, and one of the key things that we look for, is the fact that the worst of this high interest rates will crunch, will actually avoid. Uh, this is a REIT that's able to avoid it. And if they're able to avoid it, then they are in a position. So if you look at Capital DC, the debt profile, it is quite clear that the bulk of the debt, are coming due only after 2025. In fact, there's nothing left to refinance this year, 0% to be refinanced next year. So this means that this sell off, this huge sell off Capital DC may trigger a very good opportunistic buy. Or is it so? Well, if you want to find out in great detail, do try to sign up for our next Read It quarterly class on the 2nd of December, where we discuss things like this in detail. And this has actually been held at the OU the Hilton Singapore on 2nd of December. In today's feedback, I also want to share with you one of our students, the newer students that just joined. Our older students have been with us for the last 34 years, and this is actually from Miss Evelyn Koo. She said that thanks for the thoughtful reply. That's because even after the class finishes, the participants, the investors, we still reply to your email on questions on specific of REITs, when to buy, when to exit, how to position, and what are the REITs to watch out for. So in this case, she mentioned that as usual, you provide insights to learn from and what to be mindful of. Remember, the whole idea of investments is to protect your capital, and that's where we stand. Now, these lines are also reflected in the years and depth of your experience. Appreciate it. Thank you, Miss Evelyn Koo, for your kind feedback. Well, for those of you who do not know us, I'm Gabriel Yap. I was probably Singapore's youngest head of research when I was head of research at Nico Securities, and then I went to work in Wall Street from 1996 to 1998. Came back to Singapore and I was head on institutional sales in a couple of local stockbroking as well as international stockbroking companies before I retired in early 40s to actually enjoy life. And one of the key things that I have been able and successfully been able to do so, and therefore parlay and share with you in our investment classes, is the fact that do everything you can to protect your capital. Not before the event, but way before the event and not after the event has happened. And when interest rates are basically that high, REITs may be attractive, but considering the fact that if there are opportunities to make just 5% for investing in fixed deposits or government securities. Now that would threaten, the beautiful aspects of REITs. While REITs basically continue to stay um, attractive because of the discount to NAV, we basically think that compared to other alternatives, that's where an investor basically have to be positioned and wary of. So do join us for our 2nd December classes where we discuss this in greater detail to help protect your capital and grow your wealth in real estate investment trusts for you, ladies and gentlemen. Till next week then. Cheers.